Hi everyone, there are so many companies out there to invest in and we can't do a deep dive into all of them. So I thought I would go through with you a relatively quick way to filter through all the ideas. Now pretty much every company could potentially be a good investment, and I bet all the CEOs of every company thinks their company is the best company in the world. Just like every investor out there thinks their stock portfolio ideas is like it's the best in the world too. So I had to work out a way to filter through all these ideas. So I'm going to go through my filters and you can take these and apply them yourself to any company you're looking at. It takes about 5 minutes to decide whether I should dive deeper into the company and do a full analysis. I would never consider investing just on these filters alone. It's just a decent way to rule out all the potential ideas so I don't waste too much time. Now what I used to do is study a company in detail first and then go and check the stock price, only to see it was crazy overvalued. So that process wasn't time efficient, so now I try to filter out things first. Okay, now for the example today, I'm going to go through BAIDU and I'm going to give it a valuation as of July 2021. So the things I'm going to be looking for are revenue growth, gross margin improvement, return on invested capital, the current ratio, the free cash flow growth, shares outstanding, insider ownership, and then the price. And I'm going to do these really quickly so I can get a feel for the company, whether I should dive deeper or not. So let me show you how this is done. So revenue growth. What I'm going to do first is I go over into Morningstar and in the URL, I change it to the company ticker, BIDU. So that's BAIDU. Now, you've got to remember, these numbers are in Chinese yuan, so we will have to do some conversions at some point. But the first thing I'm looking for here is revenue growth. So here's the revenue, and I look at from say 2016, 2015, 2016 is a good number to start at. It was 70 billion Chinese yuan. Now it's 107 billion. So yes, that's growth. Great, we can give that a tick. Now we go have a look at gross margins. Now that's really easy. It's right here, it's underneath the revenue. And the gross margins for the last 5 years is 50, 49, 49, 41, 48, back up to 50 for the trailing 12 months. That's not too bad. It has sort of declined and then gone up again. It has 10 years ago was in the sort of 70s and 60 ranges. So it has declined, but the last sort of, 5 years is pretty stable. I think we can give that a pass mark for now. It's not seriously declining. So we'll give it a tick. Okay, now return on invested capital. Now return on invested capital, if you don't know what that is, it's really the management's ability to use the money that they make to reinvest back into the company to grow the business. And the higher this number is, the better the return on those new investment ideas that the company is making. So the higher the number here, the better. Hope that I explained that clearly. If you want to know a little bit more of return on invested capital, there's plenty of resources out on the internet to work that one out. Essentially, it's, how would I say it as quickly as possible? I think essentially it's just how good the company is at growing the business, essentially. That'll do. So how I find that is I go into profitability, and in the profitability tab down the bottom here, it actually has it here, return on invested capital. And since 2016, it was 7%, 11%, 13, well, negative. It was a negative number here, back up to 8. Trailing 12 months is 16. It's not great. I'm going to give that a half mark. I've seen a lot of companies well over 15% and consistently over 15%. So I'd prefer to see over 15%. There's not many 15s here. It was 5 to 10 years ago. The numbers were a lot better, but since then, not as good. So we're not going to give that a pass. We're actually going to give that a cross. The current ratio. The current ratio is the ability for the business to pay off its short-term debts. Very important. We don't want the business to be in any sort of financial troubles of any kind. So what we do is we go into the actual financial statements, and we actually got to go into the balance sheet specifically. So in the balance sheet, we're looking for this total current assets number. Here it is here, 191 million Chinese yuan. And we look for the total current liabilities of only 66. So we want current assets to be bigger than current liabilities, which it is, and it's significantly bigger, which is great. That's pretty much all we needed to see. I'm happy with that. Let's give that a tick. Now we're looking for free cash flow growth. So back in our key ratios section of Morningstar, we actually have free cash flow as its own line. So that's pretty cool. So we can go back for the last 5 years. It was 11 billion, 18, 13, 9. So it dropped a little bit there, but back up to 18 again. So it's gone from about 11 to 18. Potentially the trailing 12 months is even higher, a little bit more. So it has been growing, although inconsistent. It is bigger the last year or so, but that could be pandemic related. So I don't want to give too much credit to the free cash flow growth here. So look, let's go to a compound annual growth rate calculator. And I've put in the 2016 number and the 2020 number over the last 5 years, and it has grown at about 10% according to this calculator. So maybe 10%. I'm happy enough with that at the moment, but it's not great. This is a bit inconsistent, and I would want to maybe wait another year to make sure the pandemic isn't really affecting this free cash flow growth, but that's how you look for that number. So we'll give it a half mark. Shares outstanding. Okay, here in the key ratios, we have the shares here. Here's the line of it here. Since 2016, it's actually the same value. It's 348 now. It was 348 5 years ago. It's gone up and down a little bit along that timeline, but it's pretty much the same, so I'm happy to give that a tick. We don't want that increasing, because if it's increasing, it means there's more shares that exist in the world. Therefore, our ownership in the company is getting less and less. We're getting diluted. So if that number was actually heading downwards, it means that the company is buying back shares, destroying them, so canceling those shares, and then whoever's left holding the shares after they've done that cancellation, well, it means we own actually more of the company. It's actually a really good way to return value to shareholders, and I really like to see that shares outstanding going down. We don't want it going up. That's really important. If it's going up, it means that our expected returns are going to be far less than we think they are. Be careful of this one. That's why I've got it here on this list, because it's very important. Okay, insider ownership. Now, to find insider ownership, you can Google this, and there's lots of different ways to do this, but I use Simply Wall Street. You can sign up. I just changed my email address to sign up and keep getting the free version. Now, this is Baidu's board members. I've just scrolled down. This is sort of what Simply Wall Street looks like. And the co-founder has 20% ownership in the company. That's fantastic. Anything above 5% is actually really strong. So we can see individual insiders are holding still 20% of the company. That's him, obviously, this guy, the co-founder of the company. Fantastic news. That's all we really needed to see. I'm happy to give that a big tick. Now, last but not least is the price. Now, this is obviously very critical, and this is what we've been working towards now. So what I need to do is I go to my intrinsic value calculator. Now, what I'm going to do is I have to do some estimations for these growth rates. Fortunately, here in Morningstar, I have a growth section here, and I can see that the revenue has been growing over the last 10 years at about 30% per annum. But as you can see, these numbers have declined. So the year before, it was actually growing at 42% per annum over a 10-year period, then 61. So it was higher, and now it's slowing down. Obviously, it's getting pretty big, the company, so we're getting down into a more manageable growth rate. The 3-year average is 8%. I actually like to look at these 5 and 3-year averages, because that's giving me more of an updated trend of what's actually going on here. So 8, maybe 10% growth is sort of what we're seeing on the revenue. The earnings per share last 3 years is about the same. And when I did the free cash flow, it was about 10%. So I'm happy to put that at 8% to be conservative for the next 5 years. And we'll say it keeps slowing down gradually down to about 5% annual growth rate. Okay, so my return on investment goal. This is what I want to achieve out of the stock. Now, I'm going to aim for 30% per annum. That's very high. You might be thinking that's insane, or you're never going to get 30%. What I'm actually trying to aim for is something over 20%. But I don't have any margin of safety built into this calculator. So what I do is I go for 30%. It really means it's like a 65, 70% margin of safety at 30%. But if I can get anywhere near a buy price with a 30% return on investment goal, well, I think if that doesn't quite work out and my assumptions are a little bit wrong and something goes wrong with the company, whatever, I still probably am going to get somewhere around that 20% range because I've built in this margin of safety. So at the moment, I really like to use 30. I'm even considering putting that even higher for the future, but 30 I think is a really strong discount rate to try to achieve. Now, this is a great company, BAIDU. It's a big tech company in China. If you know anything about it, it's a strong company. So I'm going to give it a 20 multiple we could sell it for in 10 years. That's a free cash flow multiple. That's pretty standard. We're just trying to get a bit of a feel. Sometimes companies at the moment are trading at 50 times or 30 times, but on average, generally speaking, big companies sort of go between 15 and 25. So I'm going to call it 20. Now, operating cash flow minus maintenance Capex. This is also, you can call it free cash flow. These numbers are often a little bit harder to find, this maintenance Capex number. So it's easier to just find the free cash flow. And fortunately, here in Morningstar, we get a free cash flow number given to us. Now, over the last 5 years, we have 11, 19, 13, 9, 18. I don't really want to average that out because the business has hopefully got a little bit better. I'm happy to use about 18 maybe. The last trailing 12 months is going to be well over 20. That could be a pandemic related year. I'm not really sure. Let's call it 18 billion Chinese yuan, and I'm going to have to convert that, which gives us around about $2 billion US dollars. Okay, 2.8 billion US dollars. So that's fine. Okay, I already put 2.9 in here, so I'm just going to change that to 2.8. Now I'm putting these in millions actually, so it's 2,800 millions of US dollars. Okay, shares outstanding. Okay, so we've got 348 here at the moment. I think I just made that 350 just in case they do increase a few shares. I don't know what's going to happen, but 350, you can just be close to this, fine. Total cash and total debt. Okay, so total cash, what I do is I go to Yahoo Finance and I go to the statistics tab, and down the bottom, I find the balance sheet. It says total cash here, 162 billion. Now 162 billion is 25 billion in USD. So 25,000 I've got here, 25,000 millions. And the total debt, I did the same thing. I've just pulled this 82.68 billion number here from the balance sheet in Yahoo Finance and put it firstly into US dollars and put it here into my calculator. That all spits out $85 would be a great buy price for BAIDU. And I go and have a look at the stock price and we're at 181 at the moment. So we're not even close. That's great. I can just push this aside. Maybe I want to tinker around with these growth rates a little. Maybe I think there's a lot of promising signs out of BAIDU. I don't know. Maybe we can be really aggressive and think that you can grow at 12%. And then maybe 8%. And look, it still only means I should be buying it at about $100. So regardless, this company, in my opinion, is overvalued based on the numbers that I've looked at so far. Look, this is just, it doesn't mean this is a bad investment. It just means from the surface level, a surface level look means that this is overvalued. And what I would do now is I'm actually going to push this to one side and I'm not going to worry about it. So I would move on to another company. But look, if you love this company for whatever reason, you would just do a lot more digging and you would find, so for the price here, I'm going to put a cross. But if you did a lot more digging, you might find something that I'm missing out here by this surface level approach. But like I said, this is the way to filter for companies and this is just a quick analysis. So I hope you enjoyed this video, and if you did, please hit the like button for me so I can get some feedback on whether this was a good or a bad video. The likes do help the video spread to more people who might be interested. The brokerage accounts that I use to buy my investments are Interactive Brokers and Saxo Bank. Now I have links in the description. These are the safest two brokerage accounts that I personally use. Look, don't get sucked into those free trading apps like Robinhood. Those don't give you access to international markets either. Now, my links are affiliate links, so if you want to support my channel, that's the best way to do it. And please also remember that this is all just my thoughts, and I'm sure I have plenty of biased opinions, so please take responsibility for your own decisions. I'm not going to ask for a cut of your profits, so don't blame me if you lose money. Thanks for staying to the end, and I'll see you in the next video.